Good morning, my name is Carl Williamson. I'm the manager of the Nexus Global Solutions portfolio and Nexus Global Dynamic portfolio. I'm speaking to you today from our offices in London, and it's August 2022. Nexus Global Solutions was up 4.1% in July, while Nexus Global Dynamic was up 7.7% during July. That takes the declines this year to minus 10% for Nexus Global Solutions and 8.3% for Nexus Global Dynamic. Global stock markets ended the month on the front foot. Stocks rose despite of, or arguably because of, a patch of soft economic data that we saw during the month. July's economic releases provided further evidence that growth continues to soften. Inflation continued to reach new highs, while PMI data showed that activity was beginning to slow. The jobs market, however, continued to provide a bright spot. Markets increasingly priced in rate cuts for 2023, and this helped support risk assets during the month. Growth stocks in particular benefited and recouped some of the losses that we've seen earlier in the year. The main macro event during the month was that the Federal Reserve put up rates by 0.75%. This was the second month they've done this, and they are now in the range of 2.25% to 2.5%, although it was widely anticipated by markets. The ECB also delivered its first rate hike in a decade, taking rates out of negative territory. US corporate earnings season is now in full swing. While the ratio of companies beating estimates versus those missing estimates has declined, overall results have been fairly solid. However, it is important to remember that these results are backward-looking and don't reflect the current patch of economic soft data that we are seeing. Tesla, Netflix, Amazon and AMD were among the best performers during the month, all returning in excess of 20%. The general better performance from technology stocks meant that the US region was the best performing region during the month. Japan also did well, while emerging markets and Chinese equities were a bit more mixed. So far this year, much of the equity market decline has been driven by a de-rating of equities. Earnings downgrades do pose further risks. However, at the moment we feel that what is priced in is a modest earnings downturn. We remain cautious, but not overly bearish, given we do not know how long the downturn will last. We continue to adopt a pragmatic approach, which means that we are looking constantly at stock selection and regional selection and making changes as and when we think they are required. We also maintain a good cash balance, so we have something in reserve should markets continue to be volatile as we move through the third quarter. Whilst we aren't necessarily through the worst, last month does demonstrate the benefits of staying invested. Thank you for listening, and I look forward to speaking to you next month.